Okay guys, so this is part 3, and by this video you understand two things now. You understand firstly how to identify the trend, you understand how you apply the moving average to your chart, how you change it to the 200 moving average, and more importantly you understand your time frame, your trading time frame and then your higher bias time frame. So by this video you understand that. If you don't understand that by now, guys, go back and watch the previous videos and try and get a greater understanding of that, because the more that you watch it, the more that it'll sink in. The more that you look at the chart, the more that you'll see these patterns play out. So what I'm going to do is talk about the psychology behind. Firstly, we've got the moving average, the psychology behind the Fibonacci next. And we're going to be delving into the Fibonacci in this video. But the most important thing on this strategy is we need one magic number. You know what that magic number is, the 0.618. So let's talk about the psychology behind it. The first thing that we're going to do is get up our Fibonacci, go to the left-hand side, Gantt and Fibonacci, and you go on Fibonacci retracement tools. And then what it's going to look like, we just go back and reset that template, apply defaults. What your Fibonacci is going to look like is this. Now, does this confuse you? Look at all these numbers. You've got the 0, you've got the 236, you've got the 382, you've got your 0.5, you've got your 0.618, your 786, and then you've got your extensions down here. Right, okay. Let's simplify this. Let's simplify the Fibonacci and let's talk about why the Fibonacci works. What we're going to do first and foremost is I'm going to show you how you can simplify the Fibonacci by just double-clicking the tool, and then that's going to bring up this. So what we're interested in is the 0.618. So why overcomplicate things? Let's get rid of the 382. Let's get rid of the 0, the 236, the 0.5, 786, and we'll get rid of the extensions, the 1618, the 2618, the 3618. And then we're left with the 0.618. So what's your favorite color? What's your favorite color, guys? I don't know. Green's pretty bullish. So we use green for the 0.618, and that's the one that we're interested in. So for this strategy, I want you to go and do that. If you're interested in the 0.618 and you're using this strategy, the 236 is irrelevant, the 386 is irrelevant, 786 is irrelevant. They're all irrelevant apart from the 618. So that's what we're interested in. Go and do that on your trading view before we move on to the next step. Now I'm going to talk about Fibonacci a little bit in this video and the aim of the game as far as the strategy is concerned. So how do you apply a Fibonacci retracement tool? Fibonacci retracement tool, remember? How do you apply it to your chart? So what we're looking for, guys, is we're looking for a swing from the bottom to the top. We're going from a swing low to a swing high. So that's how we're measuring our Fibonacci tool. So just get it. There's your swing low. And then there's your swing high. So the aim of the game is a pullback to the 0.618, the golden zone, the 0.618. So we need the 0.618 for the next step of the strategy to be triggered. So you're looking for a push to the upside. You've hit a resistance level. This resistance level is going to be an important level. This is just the psychology behind it, guys. We'll go into actual price action in future videos. We'll go and have a look at the Fibonacci on actual price action later on in this video as well, just so you could see the sticking points and why these Fibonacci numbers work. So this swing high is the important thing, because this swing high is going to be the profit taking zone for the strategy. So we've identified that we're bullish. We've got 200 moving average. Identified we're bullish. We're above the 200 moving average. There's our 200 moving average. We made a swing to the upside. We're waiting for a pullback. Price will do this. Price will do this. And then we're going to add a trend line in. We're going to go through all this in future videos step by step. We'll add a trend line in. We're going to have an indicator on here as well, which is going to be the Stochastic RSI. We'll talk about that in future videos and the psychology behind that. That's going to tell us that it's oversold. And then we're waiting for the next thing, which is going to be a break of trend. Then we're going to be putting on our risk to reward tool, and we are going to need a minimum of risk to reward. And we've got some more rules here, because where's the protection? Below the swing low. Where's your take profits? This previous resistance level. Why is this your take profits, guys? Told you in the previous video, because this is a conservative level. If this trend doesn't continue, the bare minimum that is most likely to do is come back and retest the previous high. So what I'm saying is, if this trend fails here, double tops here, and then pulls back, which happens time and time again, guys. This is resistance, remember? That's resistance. It's testing the previous resistance level. The bears are having a battle of tug of war between the bulls. Sometimes the bears win, sometimes the bulls win, but there's choppiness at this level. So that's where the bulls need to break for a continuation to the upside. But what I'm saying is this, you might get higher profits, but it's going to hit a lot less. By testing the previous high, that's the conservative level, because the bulls, to try and push price up to the upside and continue trend, need to at least hit the previous resistance and then break through. So remember, buyers and sellers are fighting here. Buyers and sellers are fighting there. They're not fighting here. They're not fighting here. They're not fighting here. The bears are laying off. The sell orders are laying off until they get to this level, previous resistance. So that's where you've got the sell orders. And that's why it's easy to have a conservative level, or it's more likely as far as price action is concerned to have a conservative level. However, we've got another rule that we're going to be talking about in future videos. You need a minimum of 2-to-1 risk to reward. Why is that, guys? This is a high probability move. If you've got a risk to reward of 2-to-1, that means that you're risking one part of the capital to 2 parts for the reward. That means if this plays out 50% of the time, that means that you'll be highly profitable. If it plays out 50% of the time over a long period of time, when you analyze all your data together, put it all together, and it's more than 50%, guys, that is highly profitable. That's a money banking machine if you can manage to get a 50% win rate on something like this. However, what had happened, and this is something that you need to factor in, guys, and this is why it's an important rule. Sometimes you get a volatile break to the upside. If you get a volatile break to the upside like that, what does that do to your risk to reward? If you're waiting for the candle close, which you need to do, otherwise price could pull back in, that doesn't give you enough of a risk to reward. And if it doesn't give you enough risk to reward, guys, what does that do overall? It skewers your data. It skewers your data. You're not taking the right rules. If you're not taking the right rules, you can't collect the data. If you can't collect the data, you can't see if you're consistently profitable. You can't look at what works and what doesn't work. So that's the aim of the game, guys. And if I'm going a little bit too far, just let me know in the comments below and I'll come back to you. I'll come back to each and every single one of you. If you've got problems setting up your chart, if you've got problems understanding your time frame, I'm here to help you guys. So you can see how the if-then syntax rule-based system works. Let me just go through it as if we were a robot, guys. We're going to go through the stochastic, we're going to go through trend lines, we're going to go through things in future videos. So just bear with me and I'll go through all of it together with you. So if you think of a push to the upside, you're pushing to the upside. If we're bullish, we're looking to push to the upside, we're hitting a resistance level. And then once we've hit a resistance level, what does that mean? We've put in a new high. So what does that allow us to do? It allows us to put our Fibonacci tool from the previous swing low to the previous swing high, knowing that we're pulling back. Now, whilst we're pulling back, our indicators are going from overbought to oversold. Indicators are going to reset, which is giving momentum to the bulls in an uptrend. This is the uptrend scenario, giving momentum to the bulls in the uptrend. Then we're putting the trend line on there. Once we've put the trend line on there, we're waiting for the break. Once we've got the break, you wait for the close. Once you've got the close, you've got a minimum risk to reward by putting your stop loss below the previous swing low, shooting for the previous swing high. So that is the aim of the game, guys. That's the aim of the game. So let's put it in a rule-based system. If price is above the 200 moving average, then we wait for a price to put in a new high. When price is put in a new high, then we're waiting for a pullback. What we do is we add in our Fibonacci from the swing low, then we put it to the swing high. We're waiting for a pullback to the 618. Whilst we're doing that, we're adding the trend line. If we break trend, we're waiting for the close. Then we're putting the stop loss below the previous low. And then we're shooting for the previous high. Right, okay, guys, we're going to write this down and we're going to do this step by step. So what I want to show you before we finish this video, guys, that might have sounded complicated, guys, but if you've got it written down in front of you, you know exactly what you need to do. Once you've practiced it on a chart, you know exactly what you need to do. These things will click, I promise you. So what we're going to do, guys, I'm going to stick some Fibonacci numbers on here. These are not part of the strategy, but I just want to show you why Fibonacci works. So we're looking for sticking points. We're looking for sticking points on retracements. What I've done is I've added the 3 main Fibonacci numbers that I used, the 382, the 618, and the 786. For this strategy, we're just using the 1. Just get rid of this, get rid of that background. So for the strategy, we use a 1, but for price action, I just want to show you how price reacts to these numbers. Let's get this up. So let's get rid of the fib tool and let's stick on our retracement tool, and we're going from swing low to swing high. Now let's follow this, guys. So we've gone from the swing low and we've gone from the swing high. Price has come back. First place it's hit, 382. Now the 38.2% retracement, guys, that means it's retraced 38.2%. That's a shallow retracement. If you get a reaction from the 38.2%, and this is irrelevant to the strategy, by the way, so this is just education. So if you get a strong bounce from the 382 and a continuation, that's showing that the trend is really, really strong, showing that you're likely to get a continuation of trend. Shallow 382 pullback. Now, why don't we use a shallow 382 pullback on our strategy? Tell you why, guys. Because remember, we're looking for a minimum of 2-to-1 risk to reward. It's all about risk management. So if we are looking for a 2-to-1 risk to reward as an example here, and we're pulling back to the 382 here, you need to be thinking where the high is and where the low is. That's not a swing low. This is a swing low down here. So if we're shooting, or if we're pulling back to the 382, we're pulling back for a 382, we're waiting for a reaction, waiting for a bounce back up to the previous swing high. We've got our risk to reward below the previous swing low, all the way down here. It's a 1.19 risk to reward. That doesn't work, guys. So by having a 618 retracement, and it doesn't work here, by having a 618 retracement, brings your risk to reward right down. It increases your reward, reduces your risk. And that's why we're using the 618 in this strategy. So you can see here how price is reacting. Look, it's bouncing 382. It's come back up. Where's it come back down? It's bouncing 382. You've got your 200 moving average, guys. Look at this. It's a sticking point. Price is following it. 382, rejection, 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 rejection. Where's price hitting? 38.2, bouncing off the 200 weekly moving average. Then you're getting a pullback. You've got a pullback back to the 382. Where's it hitting? 200 moving average, resistance. This is all support and resistance, guys. Support and resistance. Then you break through the 200 moving average, and then you turn bullish for a short period of time here. One thing you can see is you're trading in a range. This is choppiness here. This is sideways action, guys. This is indecision. When you've got indecision, you can't really trade above the 200 moving average and below the 200 moving average for a long period of time and continue trend. This is not continuing trend, guys. This is temporarily moving in a sideways range. So you can see the choppiness, but I just want to show you how these Fibonacci numbers react. So 382, that was getting a reaction. Let's do some more. This will shock you guys. Just get onto the charts and do this yourself because it'll shock you because you can get an edge with Fibonacci numbers. Fibonacci from its swing high to its swing low. Where's it come in? It's reacted at the 618. It's broke through at 618. It's come back 786, rejected at 786, come back down, tested the 618 as support, come back down, rejected at 786, all the way back down. If we added some extensions on there, that's probably going to be Fibonacci extension numbers down here. You can do it anywhere, guys. Let's do it from here. Do it from here to the swing low. Look at this. Price comes back and reacts between the 618 and the 618 and the 382. Bouncing between there. That's your support and resistance. That's your support and resistance. It's reacting from the 200 moving average. You can see here it's bouncing from the 200 moving average. Let's add some more fibs on here, guys. Do it time and time again, anywhere on the chart, on any chart. Some charts work better on 786s. Some charts respect 618s more. Some charts hit 382s and just go absolutely parabolic. But you can see here, push to the upside. Where's it hitting? 382, pull back, bam, rejection, push through, comes back, support, support, support. So that's just an example of why fibs work, guys. Why do you think Fibonacci numbers work? It's all about traders. It's all about different types of traders. It's all about eyes on the chart. So you've got your trend continuation traders. You've got your trend following traders. We're trend following traders because we're trying to swing for the previous swing high on the bullseye strategy. If we were continuation traders, we would be looking to break the swing high and then continue trend to the upside. You've got your reversal traders. You've got your head and shoulders traders. You've got all these different types of traders. People use Fibonacci. People use indicators. But when you add the analysis on the levels, on the chart, a lot of the time they coincide with what everybody else is watching. So just as an example, guys, you've got, let's stick a fib from here. You've got Fibonacci on here, and we're sticking the fib to the swing high. Now, you imagine Fibonacci is something that's widely used by a lot of people. So think of the psychology behind it. Don't think of this as candlesticks. Think of it as people putting in buy orders and people putting in sell orders. So sometimes people have got more confidence. People are buying. Sometimes the sellers become buyers. Sometimes the buyers become sellers. So you're pulling back to the 382. if everybody is putting a retracement tool on here and they're putting it from the swing low to the swing high, and everybody's waiting for a shallow pullback, everybody's adding this support zone on there. That support zone is the 382. So if everybody's waiting for that as a support zone, what does that mean? This is sitting at 60,158. That means that people are putting buy orders, buy orders, buy orders, buy orders. And what's happening, guys, is people have got confidence in it. So all of these traders, they've got all the eyes on this 382 level. They're all putting their buy orders in at the 382 level. And that means there's more buy orders at 382 level. So that pushes price up and it pushes price up and it pushes price up. But what happens, guys, is the more that you touch it and the more that you touch it, the more that the buy orders get eaten up. So imagine there's 100 buy orders here. You've got 50 buy orders here, and then 40 buy orders here, and then 10 buy orders here, and then 5 buy orders here. Basically, what's happening is eating up the buy orders and eating up the buy orders until there's more sell orders than buy orders, and it pushes price below, and it pushes price below, and it pushes price below. And at that point, the bears regain some form of momentum because there's more sell orders than buy orders. But what I'm saying is it's all eyes on the chart. That's why I say time frame is important. That's why I say the higher the time frame, the higher the conviction. Because if you're on a weekly chart, there's more people watching it because more people have got time to watch it because you don't need to watch it every single minute, every 15 minutes, every day. You can watch it every month, guys. Everybody's watching the weekly chart. Everybody's watching the 200 weekly moving average. Everybody's watching those things. So when you go into the weekly chart and you see a sticking point like this, and the bulls buying up and the bulls buying up and the bulls buying up and the bulls buying up, that is because, guys, that is because more people are on the chart, and the more eyes on the chart, the more buy orders, the more sell orders, until ultimately you try and you try and you try and you try, and the more times that you're hitting it, the more the buy orders are getting eaten up, and then at some point there's more sell orders than buy orders, pushes price down. Where does it push price down to, guys? 200 weekly moving average. Why is that? Because everybody's got their eyes on the 200 weekly moving average as the next line of support. So that's why you can get clues from the market, guys, with Fibonacci, with moving averages, and that's why we're integrating it into our strategy. That's why I'm not using the 382. That's why I'm not using the 786. I want the 618. Why am I not using the 786, guys? Because what you're looking for is retracements. You're looking for a retracement, and a healthy retracement is the 61.8. Now, the 786 can be a strong retracement, but what that's saying is the trend's weakening. We can identify that the trend's weakening on the 786 because the bears have managed to push price 78.6% of the previous swing. And ultimately, guys, the previous swing, once you've pulled 78.6, once you hit 100% of the previous swing, that's going to be a double bottom. That's showing the bears are regaining some form of momentum. It's going to be really difficult for the bulls to put in a new higher high. And it's showing that if we break and close below the previous swing low, that is your indication that the trend's reversed. Now, it's an important thing to understand that if you break and close below the previous low, the trend has reversed. What does that allow for, guys? That allows you to know that that's where you put your stop loss. That's why we put our stop loss below the previous swing low. That's why we do it on this strategy, guys. The stop loss needs to go below the previous swing low, because if it comes back below the previous swing low, that means that we're wrong. If we're wrong, we want to be wrong with the least amount of capital, and that's the aim of the game. So, guys, it's not a definite thing. If we've got a 2-to-1 risk to reward, we've got a 50% win rate. That means 50% are going to lose. So think about that. How does your mind work if you're going to lose 50%? Let me tell you something. The best traders in the world, they've got about a 30, a 33, a 35% win rate. But that means that they lose 2/3 of their trades. So how would that make you feel psychologically if you lost 2/3 of your trades? Ask yourself that question too. So that is the Fibonacci, guys, and that is the 618. That's the thing that we're interested in, is the 0.618. So I hope you've got a little bit of a gist to it now, because I do tend to ramble a little bit, guys. But basically, we've looked at the 200 moving average. You know by now your time frame analysis. If you don't know your time frame analysis, you're going to ask me. You're going to tell me what times you're going to be at the chart. You're going to tell me what times you're going to be consistently at the chart. And then once you know that, understanding the Fibonacci, checking your Fibonacci tool, you're adding the 200 moving average, and these are all tools and components for this strategy to work out. So we're going to move on next to the stochastic RSI in the next video.